The stock market is crashing. And honestly, that's amazing news if you know what you're doing. Let's have Dudley help us out. Most people are panicking right now, selling everything, moving money into savings accounts, waiting for it to blow over, so to speak. And that's exactly the wrong move. And by the end of this video, you're going to understand why. Not just take my word for it, actually understand it. Because the market dropping isn't the problem. Not knowing what to do when it drops, that's the problem. So let's fix that. So first, what is actually going on? Right now in 2026, you've got tariffs being thrown around, trade tensions between major economies, global uncertainty, and markets hate uncertainty. When investors don't know what's coming, they pull money out. That causes prices to drop. Other people see prices dropping, they panic and pull out too. And that cycle feeds itself. That's what a market crash actually is. It's largely psychological before it's anything else. Here's the thing though, this has happened before, many times. The 2008 financial crisis, the market dropped nearly 57%. People thought it was over. By 2013, it had fully recovered, and then it more than doubled after that. The dot-com crash in 2000, brutal. The COVID crash in 2020, fastest crash in history, markets dropped 34% in 33 days. But it recovered in 6 months and then hit record highs. Every single time the market has come back. Not because someone got lucky, but because the market isn't just numbers on a screen. It represents real companies making real products, serving real customers. And the world doesn't stop needing things just because the news is scary. So when the market drops, what's actually happening is that everything is on sale. And the people who understand that, they're the ones who come out ahead. So what do you actually do? You buy. Carefully, consistently, you buy. Now here's where the theory gets interesting. There's a concept called dollar cost averaging, and it sounds complicated, but it's genuinely one of the most powerful and simple things you can do as an investor. Here's how it works. Say a share costs 10 bucks. You've got 100 bucks to invest. You could throw all 100 in today and get 10 shares. But what if instead you invested $25 a week over 4 weeks? Week 1, share is $10, you get 2.5 shares. Week 2, market keeps dropping. Share is now $8. You get just over 3 shares for the same $25. Week 3, $6 a share, you're getting over 4 shares. Week 4 starts recovering at $9, you get nearly 3 shares. By the end, you got more shares than if you'd actually put it all in on day 1, and your average cost per share is lower. You've actually benefited from the dip because you were buying consistently instead of trying to time the perfect moment. Nobody can time the market perfectly. Not professional investors, not hedge funds, nobody. Studies consistently show that time in the market beats timing the market. The longer you're in, the better your odds. Dollar cost averaging is how you stay in without betting everything on one moment. Warren Buffett, arguably the greatest investor alive, puts it simply. Be fearful when others are greedy, and be greedy when others are fearful. Right now, everyone's fearful. So let Dudley be greedy. Now the what to buy, because buying consistently is one thing, buying the right thing is what protects you. And this is where most beginners get it wrong. There's a concept in investing called diversification, and the whole idea is this. Don't put all your eggs in one basket. When you invest in a single company, you're exposed to what's called unsystematic risk. That's the risk specific to one business. Bad earnings report, a CEO resigns, product fails, your investment takes the hit. But when you spread your money across dozens or hundreds of companies in different industries, different sectors, that risk gets diluted. One company having a bad year doesn't sink you. The easiest way to do this, especially starting out, is through something called an ETF, an exchange traded fund. Think of it like a pre-built basket. Instead of handpicking individual shares, you buy one fund that holds shares in hundreds of companies at once. The S&P 500, which is basically a collection of the 500 largest companies in America, has returned an average of roughly 10% per year over the last century. Not every year, some years it drops, some years it surges, but averaged out over time, 10%. And you can invest in an ETF that simply tracks that index. You're not betting on one company, you're betting on the entire economy. And here's what makes ETFs even smarter. The fees are tiny. Some of the most popular index ETFs charge as little as 0.03% per year in fees. Compare that to actively managed funds, where a professional is trying to pick stocks for you, often charging 1% or more, and the data shows most of them still don't beat the index. You pay less, you get more. That's the deal. You don't need to be a stock picker. You don't need to analyze company earnings. You just need to be in the market consistently over time, and the index does the work for you. Now, this is the most important part. Do not sell. And here's the actual reason why, not just trust the process. The math is genuinely brutal if you get this wrong. Research on the S&P 500 shows that if you invested $10,000 in 1993 and just left it alone, by 2023, you'd have around $180,000. But if you miss just the 10 best trading days over those 30 years, you'd have less than 80K. 10 days out of 10,000. That's how much those moments matter. And here's the cruel part. The best days in the market almost always come right after the worst days, which means the people who panic and sell during crashes, they're the ones sitting on the sidelines when the recovery explodes. They miss the very days that make the most money. There's actually a concept called loss aversion, studied by behavioral economists, that explains why crashes feel so devastating. Psychologically, humans feel the pain of a loss about twice as strongly as they feel the pleasure of an equivalent gain. So, a 10% drop feels way worse than a 10% gain feels good. That emotional imbalance is what causes people to sell at exactly the wrong time. Knowing that doesn't make it easy, but it makes it make sense. Your instinct to sell isn't stupidity, it's just psychology. And now you know what it is, you can make a better decision. Here's the concept that ties all of this together. Compound interest. Einstein supposedly called it the eighth wonder of the world. Whether he actually said that or not, the math backs it up. Compound interest means you earn returns not just on your original money, but on your returns as well. So your growth grows. $1,000 invested at 10% a year, year one, you've got $1,100. Year two, you earn 10% on 1,100, not just the original 1,000. Year 10, you're at nearly $2,600. Year 30, over 17 grand from 1,000. You didn't touch it, you didn't stress about it, you just left it. That's why time is the most important variable in investing. Not how smart you are, not how perfectly you time the market, just how early you start and how long you stay in. A market crash at the beginning of your investment journey isn't a disaster. It's a discount on the most powerful financial tool you have, time. You're buying shares cheaper, earlier, giving them more time to compound. That's not bad luck. That's actually ideal timing if you hold. So here's the summary, not the watered down version. Markets crash because of fear and uncertainty. They recover because the underlying economy is real. Dollar cost averaging means you stop trying to time the market and start building a position consistently, and you actually benefit from dips along the way. Diversification through ETFs removes the risk of any single company breaking you, and compound interest means every year you stay invested, your money is doing more work than it did the year before. This isn't complicated, it's just not explained well enough, often enough to the people that need it the most. If Dudley can do it, you can too.